How's it going, everyone? It's Sam. Today we're looking at the top 5 dividend stocks that I'm holding going into 2023 that I think will do really well. Now, of course, you have to do your own research. I'm not a financial advisor. I'm not telling you to buy these, but these are my top 5 dividend holdings. And I realize that I talk about a lot of different things on this channel, from crypto to growth stocks, now even a little bit in dividend stocks, but I have been holding this portfolio for several years now, this dividend and income growth portfolio, where I've been adding $100 a week to different dividend paying companies. And today I'm going to be going over some of the top ones. So I've been doing this consistently for about 2.5 years. I just upped the amount that I'm investing into it to 150 from 100 because of inflation and just because I want to be able to fund this even a little bit faster. You can see over the last couple of years, the market gain is actually a little bit negative now, almost negative $200. But with the earned dividends of $540, it's actually put us in the green 5.31%, which compared to a lot of other companies and growth stocks and cryptos is actually really good, especially when we've fallen so much in the overall market. Now, if you want to know exactly what I buy and when, there's a link down to the Patreon. I also talk about what I buy in other companies, and I give updates as well. If you just want to follow along here on the channel, let me know in the comment section if you want me to do more of these, or if you want me to go more into depth on any of these individual companies, and let me know if you own any of these as well. So the portfolio is sitting just under $14,000. Again, not a huge portfolio, but I'm consistently adding to this. Now, the 5th largest stock that I hold in this portfolio, that's a dividend stock, is actually Microsoft. Now, I'll be doing a little bit of a high bird's eye view of these different companies, not going too into depth, but again, if you want me to go more into depth, I will. But you can see Microsoft has very consistent growth on revenue, about 10.4%. But honestly, revenue doesn't really matter that much in this kind of environment if you don't have free cash flow and earnings. You can see their free cash flow is pretty much doing the same thing over the last 10 years, 8.31% annual growth rate. Earnings per share is looking great as well. They have a significant cash position of $105 billion, and they have debts of $47 billion, so a great ratio there. They're able to consistently buy back shares, going from a few years ago, well, let's go 15 years ago, 10.83 billion shares, now down to 7.5 billion. So a significant reduction, maybe 25% or so over the last few years, over the last 15 years. They also have a very good return on capital employed, basically showing that when money comes into the business, when they try to reinvest it, they are able to get a significant amount of money back out. You want it to be over 8% for these kinds of companies, and the return on capital employed is 31%. So they're being able to take money into the business and create more money over time. Their expenses are going up with the business, but overall the cash flow is far surpassing that. And when you take in stock-based compensation as well, that's growing, but it's not even close to what they're making in terms of free cash flow. So they're not spending a ton of money on engineers compared to some of the other tech names. Their dividend is also looking good. Obviously, this is a dividend portfolio. It's up at 61%, growing at about 11.4% a year, and it's growing significantly, but also has a low payout ratio. This is a little bit more expensive than some other dividend companies at a 27 forward price to earnings ratio. But you have to realize that part of that is because it is so consistent and it's a very sticky business. We know this, that you're paying for a lot of subscriptions with Microsoft. You're paying for your company to use their products, and that's really hard to stop. They also have a large cloud business as well, which is very similar. So that's the 5th largest company that I'm holding. The 4th largest company that I'm holding is Texas Roadhouse. A lot of people don't consider this a great growth company, but they do consistently grow 12% a year. Whether you're looking at the last 2 years, last 5 years, last 10 years, it's all about 12%. EBITDA is coming in strong with a similar growth rate. They have significant amounts of free cash flow and have pretty low stock-based compensation as well. So they're able to push a lot of that free cash flow back to the shareholders. They have a lot of capital leases, which if you don't really understand that, at first it seems pretty worrisome, $644 million, but a lot of that's just due to the fact that they have properties that they work in, and they're just paying off those properties over time. You can also see they're buying back some shares over the last couple of years. They haven't put a ton of their money towards that, but some goes back to buying back shares, and at least they're staying about consistent even with more stock-based compensation. Their dividend yield is about 2%, but they're growing this significantly. Over the last 10 years, compounding at 16.5%, last 5 years, 17%, last 2 years, 13%, so consistently growing as well. So this is another compounding growth company that will continue to pay significant dividends in the future, in my opinion. They also are a company that some people don't like for the fact that they think that if we go into a recession, less people will be eating out. But Texas Roadhouse is an affordable option, I think, for a lot of people. If they want a steak dinner, it's not like you're spending $50 on a steak there. So I think more people will go to Texas Roadhouse that would normally be at nicer steakhouses if we go into a recession. We also have Apple, number 3. Also significant growth, consistent growth. Obviously, if we head into a recession, less people might be buying iPhones and iPads, but the fact is they are growing their subscription business quite rapidly as well, which we'll get into. But you can see they are buying back shares at a very aggressive rate. Back in 2012, they had 26 billion. Now they have 16 billion. So over 10 years, cutting down, 40% or so on their shares outstanding. Their return on capital employed is crazy, sitting at 60% for 2022. Now, their dividend has been pushed down a little bit just because of probably a little bit of fear of the recession heading forward, but they do have significant pricing power. We know that they have been growing their subscription business quite quickly, with now more than 900 million paid subscribers, jumping up right around 150 million since the year before. The crazy thing about this is if they just raise their subscription cost by $1, which isn't enough in my opinion to make people want to stop with their products. Just $1, for example, overall would be $900 million per month, which is $10 billion throughout the year. And they're doing this with some of their products. For example, they recently raised from $9.99 to $10.99 for Apple Music, Apple TV Plus, and Apple One. So they are able to do this, which prints significant amounts of money. I mean, this is basically all going to their bottom line. So they could raise their free cash flow by 10% if they just raise the cost of their subscription $1 a month, which is crazy. So that's the number 3 holding. Then the number 2 holding is Vici Properties, sitting at $32.40. It is one of the best performing stocks over the last year, actually coming in positive, and they are paying a nice dividend as well of about 5%. Now, this is a REIT. They own a lot of the properties in Vegas. They consistently grow as well. They do have to issue more shares because they have to fund that growth. So they're growing by buying more properties. Recently, they acquired the rest of their interest in MGM, Grand Las Vegas. They bought this from Blackstone Real Estate Income Trust, and they were able to get this at a 3.55% rate. So they're able to actually be accretive to the shareholders, buy products or buy buildings that are going to cash flow very well, very attractive. And part of this is just because of their size. And they're able to actually offset the fact that they have to raise shares, and they're actually making more and more money in terms of EBITDA and free cash flow, and being able to pay out bigger and bigger dividends to their investors. Now, one of the great things about this company as well is that their business is sticky as well. They have companies that are in specific locations, and they can't just up and leave to some business a couple miles away. They are pretty much stuck where they are, and Vici is able to continue to raise rents over time, and they have that baked into their leases. Now, the number 1 holding that I have isn't actually in this M1 Finance portfolio, but I have it in another portfolio, and that would be the Vanguard S&P 500 VOO ETF. I am trying to pick more individual companies in this portfolio, but I have this in another portfolio, and it is my biggest dividend payer right now because I have over $20,000 in it. Now, I am consistently adding to this. It pays 1.7% a year, and it's much safer than any individual company. It has less ups and downs, and right now it is down 20% in the last 1 year. So I am adding to this as well, just to take a little bit of risk off the table. But let me know your thoughts on this underneath the video. What is your top dividend payer? Let me know. Hit subscribe, and I'll see you in the next video. Bye.